Good afternoon, everyone. I hope I'm audible.
Yes, Mugdha.
Okay, thank you. Good afternoon and welcome to the sixth talk in this Only One Theme talk series. We are at the second wave from September. Today's topic is only pre-investment due diligence. This talk series is organized by the TechX.in vertical at Venture Center. Today's talk, our speaker for today is Shruti Devasthali. Let me briefly introduce Shruti. Shruti is the head of funding and investment at Venture Center here. She is a chartered accountant by training and a certified financial risk manager. She is currently operating seed fund activities for Venture Center and monitoring the investments in the Venture Center's portfolio companies. Shruti is responsible for mentoring investee companies on corporate governance and monitoring their progress in the capacity of board observer. She is also responsible for monitoring the fund disbursements under various grant programs which are run by Venture Center. She is a program manager for the DST's Nidhi EIR program, which is implemented by Venture Center through 30 plus TBIs. During her previous work engagements, Shruti has worked with Crisil Limited and Dun& Bradstreet Information Services India Private Limited in the areas of credit rating and financial analysis. So with this brief introduction, welcome Shruti to the session and over to you.
Hi, so let me begin. So today I'm going to talk about pre-investment due diligence. So as Mugdha gave a background about me. So what I'm going to discuss here is from my experience in investing about 50 plus startups uh, through Venture Center. So whenever we have invested in the startups, we have always been the first investor. Most of the times we have been the first investor in the startups. And as a process, we have done a due diligence for all these investments by a third party. So whenever we have done the third party due diligence, we have come across that the startups are not prepared for a due diligence. Most of the times we always mentor startups in terms of how much funding they require, which investors to pitch to, which investors they should tap in terms of getting funding from. But it's also equally important that they are prepared for a due diligence, because the due diligence is it's kind of a wall between actually getting the investor agreed or interested in a startup and then actually getting the money in your bank. Because only when the due diligence is done and when the due diligence report is very positive, the investors will sign an agreement and invest in the startup. So from that note, let me begin with what is a due diligence. So due diligence is it's like an investigation, audit, or review performed to confirm the facts or details of a matter under consideration. This is how Investopedia defines due diligence, and that's what it is. So if you do a Google search, you will get various definitions of due diligence, but this is very apt. So whenever you are doing any new thing, you always go for a due diligence. In case of a startup scenario, what all are the various things that you will be doing? What all are the matters under consideration for a startup? So if you look at it, investment is one. It could mean raising grants, raising equity funding, debt funding, or any other form of funding. It will also mean if you are looking for a merger and acquisition. So it can be a strategic tie-up, it can be a takeover of the startup itself, or you might want to sell off one of your technology. It can also mean a sales channel, that if you have come up with a product, but you want to get into a distributorship contract with a distributor, or you want to give it for franchising, setting up a manufacturing or outsourcing unit. These are kind of decisions that you will have to take as a startup. When you are building a team, that time also we do a due diligence, because what it is called is like a background check or reference check. But in today's talk, I am going to cover only the investment aspect of it. So what it means is, like, whenever you are pitching to an investor, you present your pitch deck to him. So whatever you are presenting in your pitch deck, each aspect of the pitch deck is something which is subject to a due diligence. The investor doesn't believe a startup just because you are presenting it. They will always do a cross verification with a third party to ensure whether whatever you are saying is right or not. And that's what it means, like that's what it is, like investigation or audit of what you are presenting to the investor. Now, when it's a pre-investment, there are various types of due diligence which are done, but the key thing is, like, if you broadly categorize those are like technical and business due diligence, financial due diligence, and legal due diligence. Usually, technical and business due diligence happens the first, because that's where the idea is verified. Whatever you present, the investor will first check the feasibility of the idea that you have presented. Whether that idea is based on, if it is based on a core technology, then the technology will be verified. For that, the investor will usually look for a third party technical expert to vet that idea, so that he will get a confidence that what you are pitching is something which is workable, and it is actually a solution that the market is looking for, and it is going to solve the problem which you are saying is a problem. So that's what happens in the technology due diligence. If the investor agrees with the technology that you are proposing, then the next thing that he wants to check is whether that technology is unique. How novel it is, or how unique it is, what kind of ownership your startup is going to have for that technology. Usually the investor will look for an IP expert for checking the uniqueness and the ownership of a technology. Next thing, if that is established, then the next thing what the investor wants to see is who are going to the customers. Whether the customers are actually looking for this solution, he will look for customers' validation, their feedback, their requirement, and that's where he will do the need identification, verification of the need identification that you mentioned. Once that is also established, when it is established that there are actually customers looking for this kind of a solution, he will go to check for the market potential. Because whenever there is an investment, the investor will want to invest into a company which can scale. So he will like to look for the scale of a business opportunity. So basically, he will look for the market potential. What is the what's going to be the market for this product, and based on that, he will take a decision whether he wants to go ahead or not. So this is all the technical part. Most of the times, what we have seen is the founders do a pretty good job in this area, at least in the first three aspects, where the technology due diligence is done, because it's their own idea, their own thought, and they are more technically capable of taking this up or convincing to the investor. But when it comes to the financial due diligence and legal due diligence, it's a new area for most of the technical startups, founders. So that's where usually it takes more time. In case of financial due diligence, what generally is looked at is, if your startup is, say, 2-3 years old, how your financial statements are looked at. Even if a startup has not made any profits, even then, what is looked at is mainly whether you have done all the compliances with respect to financial statements or not. So filing the financial statements, you have to file your income tax filings, all those are checked at this level. So also the agreements that you have signed with various parties, because initially you might sign various grant agreements, you may sign some licensing agreements, agreements with your advisors. So all these agreements are looked at at this stage, and also the obligations that you have as a startup under those agreements is also looked at. One of the examples is a royalty agreement. So if you have taken a technology in the form of a licensing from somebody, then how much is the royalty that is going to be an obligation for you when you start making revenue is looked at, because that has a financial impact. on the profit making of the startup. Similarly, whether there are any loans taken, or if the loans are taken, whether the loans are secured or whether those are unsecured, that is looked at. If you have hypothecated any asset, that is called asset under charge. If you have taken any secured loan and it is secured against any asset, then how important that asset is and whether you will be able to serve that loan or not. So all these aspects will be checked here. Equity structure is one very important part because most of the times when investment in startup is concerned, all the investors generally want to invest into a startup where the founder is 100% focused on taking forward that startup only. If a founder is having stake in multiple startups, the investors generally step back from investing into that startup. One of the reason being, it's like if they want you to put your heart, soul, and hard work, everything into that one startup. If there is another startup, and if that another startup starts growing, and if you are not putting efforts into the startup in which the investor invested, it's a complete loss for the investor. So they will always look for one founder who will have 100% dedication to the startup, and they will bet on that founder. Similarly, they will also look at what is the equity structure in the sense how much each founder owns and what is the contribution of each founder. So if there is one person holding significant amount of equity but not putting in efforts into the startup, that will not be looked at very positively. They may ask you to change the capital structure. Similarly, is there any controlling stakeholder? Like if there is one shareholder who is having significant holding, and if that person is going to have significant rights into the startup, that will also be verified. If there are any agreements with respect to that, that will be verified. Then in case of legal due diligence mainly focuses on the company secretarial aspect, legal as well as HR aspects. So what it includes is if you check the documents with respect to the incorporation or registration certificates. It also checks the records of all the board meetings, general meetings, shareholders and directors registers, etc. So it actually checks all the documentation that you need to maintain under various laws, which includes the company law or other laws to which your startup is eligible to comply. So it will also check the employment agreements with your employees. If you have any ESOP plan is also checked in terms of what are the clauses in this. If you have already given any ESOP stake to any of your employee, then how it is going to impact the cap structure and all it's verified. Loan agreements are verified to check what are the obligations the startup has. So question. Yeah, we can take questions here also.
So the question says, can you give a list in FS?
FS? What do you mean by FS?
Sandeep, you can unmute yourself. Sandeep, this is regarding your question. Do you want to?
Yes. Like when you meant the past financial statements and or any of those, could you let us know a list of usually what the like the investors would be looking at? Are you just mentioning about like balance sheet statements, the profit and loss statements, or are you looking at bank statements in detail? Is there anything else that might be there? Could you be a little more specific about what are usual the financial statements they might be looking at?
Yeah. So I have actually a due diligence checklist which I can run you through. I first thought maybe I can run you through at the end of it. Because just right now I'm just going through the process, but I will share. Sure. I actually display the due diligence checklist which has the details of that.
Okay, sure. Thanks.
Yeah. Yeah, next. So what I'm trying to tell is, like, for every startup, the due diligence The due diligence checklist which I will share is actually a kind of a universal checklist. So it will include everything that the while doing the due diligence, the professionals may ask you. Some of those will be relevant to you, some of those may not be relevant to you. But that it's I will just go through that at the end of it so that you can see what all is applicable to you and you have to keep those documents ready. So right now I will quickly take you through the process, because what happens is like many times I've seen that because of not being aware of the process or not being aware of this due diligence and the significance of it, that it delays the process, and because of that the investment process delays. So due diligence report is a prerequisite for any investment, and investors will put in money only if they are satisfied with the due diligence findings. So you have to start preparing for a due diligence as you kick off your fundraising campaign. So the moment you think that you want to raise funds, you should parallelly start internally working on setting up your due diligence documents in place. So you have to take your CS and CA onboarded that you are going for this. So you have to keep them alert that they have to make sure that all the documents are in place. Keep all your existing investors, other shareholders or directors informed. One of the key thing, one of the main reason for that is, one is that they should be knowing that you're raising funds. But another thing is also that if there is any document missing, you may have to create, the CA and CS will have to create those documents just to make sure that everything is in place, and all these could be the signatories to those documents. So if they know about it, it will be easier for you to get it signed from them. You can request your investors who are doing your business or tech due diligence to share their financial and legal due diligence checklist, so that while they are doing a technical due diligence or business due diligence, you can also parallelly prepare for it. You can even, I'm right now going to share one due diligence checklist which we use for our seed fund investments. Similarly, you will get many such checklists online as well. So you have to go through the checklist and start putting all the relevant documents in one folder. It can be a physical file or an online folder, but just keep it at one place so that whenever you start the due diligence process, you should be able to share the documents and should not spend time in creating those at that point of time. In the initial stages of startups, most of the times the startup is formed by very close members, either family members or maybe two founders, friends, or something like that. So in that case, the board meetings and AGMs are like, very informal, because they are only two board members and the same are the shareholders. So many times the documentation is not taken seriously, but it's very important that you do a formal documentation of all the meetings, put all the minutes in place, actually sign them and keep them in record. So because most of the times at the due diligence level, you will spend time in doing all these things. So being aware and prepared for a due diligence process creates a huge positive impact on investors. Nowadays, we have seen that the first couple of investment rounds like pre-seed or seed, which could be up to 50 lakhs or 1 crore, the startups struggle, but later on they realize the importance of due diligence. And many times before, when they are going for a larger investment round, they also do a pre-investment due diligence audit so that they know what all will be looked at and they are prepared for it. And when they convince an investor, there is no time spent in actually the due diligence process, so that you can get the money faster in the bank. So how to approach this due diligence process is present whenever. So whenever you receive a checklist from the professionals who are doing, usually there will be professional entities who will be a CA firm or a CS firm or a legal firm who will be involved in doing this due diligence. They generally share a checklist with you. So you should present the information or data very systematically. Arrange it in a proper folders or files, because many times searching for those documents may take a lot of time for them and it may delay the process. So arrange it in a proper files, name those properly, ask and understand the requirements before acting on the same, so that you know what exactly is required. Do not hide any facts, especially with respect to any current obligations, commitments from the investors or from the professionals who are doing the due diligence. Because if there is any equity commitment that you have done to your employee, or many times we see that there could be some incubation agreement, but you have not transferred the shares, all those things needs to be openly and clearly told at the beginning, because if this is found out after the due diligence or after the investment happens, then most of the times the investor will ask only the founder to share the equity shares to those entities, or those may be those that first of all will be looked at in a way that you did not share it, and another thing that you yourself will have to share it from your own stake. So make sure that every obligation that you have is disclosed at the time of due diligence. Um, and if the paperwork is not ready, then there could be various reasons for delay in due diligences, but the consequences are that the investment gets delayed. There is a negative impact on planned work timeline that the startup has, and it's a huge loss. Investors may find another opportunity to invest in their money faster, because there many times I've seen that there could be angel investors who come together for investing in a startup, and they just want to invest quickly. So in that case, if you cannot hold them for a very long time for just due diligence. So up to 1 month, it's still fine. But beyond that, you have to really keep engaging with them to make sure that they stay with you. Otherwise, they may find some other startup which might be more interesting, or they may want to put in money faster, and then they will go ahead with that. They may lose confidence in the way the business is managed, and that's very that reflects negatively on the startup. It also gives them a scope for renegotiating the term if something is found in the due diligence. So most commonly observed reasons for delay in due diligence are like documents are not done on time. That is one and very important reason that we have seen, because most of the times this checklist goes to the startups and then they realize, oh, these all documents needs to be presented. Then the CA starts searching for the documents. Some of the documents are with CA, some of those are with CS, some are with startups. They start collaborating it together. So it takes really a lot of efforts in making sure that everything is put together. It's always important that you create one drive or one folder where everything related to your startup is put together, whether it is done by a CS or yourself. Everything should be at one place. Also engage competent consultants. They should be aware about the startup scenario. Scenario in the sense it's like your need that you need to get money faster, and for that all these needs to be in place. There is a chance that many times because of the financial constraints, the startup may not be able to employ a complete full-time CS or a full-time CA for that. But in that case, the founder may have to put in extra additional efforts in order to understand that what all are the requirements of the due diligence, and making sure that whenever the CA is doing those things, you archive those and keep it with you at a separate folder. So I mean there is nothing else that you can do to make sure that the delays don't happen. That we have seen that many times the consulting agency asks for the documents, they share the documents, but those documents are not signed, because those documents they prepare but they just keep it because it's just amongst say family members or friends, and they don't take an effort of printing it out, signing it, and keeping the signed copies. There have been some delays if one of the shareholder is not in the same geography. If they are traveling, then getting their signatures becomes difficult. So just to avoid all these things, whenever the document is created, please sign and keep a copy of it in your folder so that whenever it is required, you can archive it from there. The requirements are not understood well is also one of the reasons, because whenever the due diligence process starts, the first thing that happens is that the checklist is shared with the startup. Many times the checklist is not looked at very carefully or may not be understood very carefully. There is a lack of communication between the startup and the DD professionals. At least it's in the interest of the startup. So I feel the founders should make an attempt to contact the DD professionals to understand what they want. Even if the founders have not understood, you can actually set up a call with your CACS or whoever is there who's going to take care of this investment process from your end. You can schedule a call with due diligence professionals so that they can actually explain what is required from their end. The checklist will be exhaustive, but you can actually parallelly tick along with those DD professionals in what is applicable to you and what is not applicable to you, and reduce the scope of work for yourself. If the another thing is the finances are not properly managed. This one thing is also very important because in the initial phase of the business, the startup and the promoters, they don't see much difference between those two entities. The promoters, if there are two founders, then those founders are individually different entities, whereas the startup is a third entity. So many times it happens that if there is any requirement of funds in the startup, one founder will put in money, but it has to be accounted properly. It is a startups accounts are separate. So if it is accounted as a loan, whether it is accounted as an advance, what kind of treatment you are going to give this money, whether this is considered as an investment by a founder, whether it is considered as a loan by a founder, there has to be a very, very clear understanding whenever you are putting money in your startup. Most of the times when you are investing, the investors will not want their money to be paid to the for repaying such kind of loans. If you have taken loan from one of your shareholder and if you want to pay it back, it will not be allowed from the investment money. So all those kind of things will kick in whenever you tell the investor that there is a loan in the company. So there has to be a mutually agreed way to sort out how this loan will be treated. Similarly, HR documentation is also an issue because in case of startups, most of the times the proper HR documentation is not maintained. There has to be a HR policy. It could be a basic policy initially. When you have, even you have one employee, you should have that. As such, the founders themselves are employees of the startup. So you can have a formal HR policy. It helps in sorting out many conflicts or many discussions even among the founders. Like if there are any issues among the founders, it helps. Setting up the policy always helps in solving the issues. HR policy is one. Similarly, you can always have policy for say purchases, in terms of like one founder making all purchase decisions is not a good compliance or a good governance thing. So you can always have like any purchase up to 50,000, say, I'm just giving an example for amount, but up to this can be done by one founder. But if it exceeds, then both the founders should agree or both the founders should sign that check or something like that. So there has to be policy set up with respect to using the funds, with respect to your HR, with respect to making decisions for purchases, etc. And that reflect a lot. For the investors, the policies may not be fine-tuned. Those may be basic policies, but having those reflects a lot, reflects in terms of you are caring for the governance. So yeah, similarly, when you are having the employment agreements with the employees, you should have certain clauses like confidentiality, non-competition. If they leave, they shouldn't be joining your competitor, or those kind of clauses you should have. Or if they are working on any innovative thing, novel thing, then all the IP rests with the company. So all those kind of clauses should be mentioned in their employment agreement to protect the startup from any kind of infringement out of it. So, usually at the end of the whole due diligence, the due diligence agency, they submit a due diligence report to the startups and to the investors. And then they go through if the due diligence report is very clean, that if you are actually maintaining all your documents properly, or if you are actually taking care of all the compliances, etc., then the due diligence report will not have any qualifications, is what it is called. So if there is any discrepancies, those are mentioned in the due diligence report. So if there are no qualifications, no discrepancies, and the due diligence report is clean, the investment happens immediately and it wins investors' confidence. It also helps many times in recent times. I have seen that many times one investment happens and then some other investor, if they want to invest in the same startup, it's very easy to take on board another investor using the same due diligence report or the same process that you have done with first investor. So when it is clean, it's easier for you to convince to the next investor also with respect to the credibility of your startup. If there is any qualification in the due diligence report, if there are some discrepancies found or if there are some non-compliances found, then time is spent on analyzing what is going to be the impact of the qualification. If there is a severe qualification, anything that's something which they feel is something, the company has really in breach of something, then the investor may just withdraw from the investment. But if there are certain things which can be rectified, there are also certain things which are not very critical, but you have still failed to meet the criteria. In those cases, you may have to pay penalties and do those things, but then there will be additional money spent on it. Another thing is that will always reflect that you had not taken care of it before. So you will have to spend time and money on making sure in convincing or bringing the investor on board that you are taking care of these qualifications. Some of the, I was mentioning that irreversible qualifications could be if there was something which should have been filed with, say, a register of companies, and you have not filed it during time frame. Now you cannot go back and file, but you will have to give the confidence, or the investor will ask you to give some obligation in writing that in future you will be taking care of it. So, but there will be additional documentation required for making sure that the investor has confidence in investing in the company. As such, the due diligence process is a very good exercise for getting the compliances and processes on track. So every founder should approach it very positively, mainly because many times if you have to get such kind of internal audit done or an investigation done to make sure that your company is following everything, it costs a lot. When it is a investment process happening, it automatically happens. So it's always better, and it's actually a good thing for the startup as well as for the investor to start from a foundation where both have full confidence in the way companies function. So that is what I just wanted to talk about, the due diligence process. Now I will share the due diligence checklist with you, and maybe I'll take you through that checklist. Then we will take some questions. After that, we'll take questions. Or maybe even if they have questions right now, I can, but I'll go through this. So here I have, this is a checklist which we use for our seed fund investments. Generally, so this is what happens is, like, whenever we decide to invest into a company, I generally connect them to the CA firm who does the due diligence for us. And then they share this checklist with the startup. So what is expected is they have listed the things that they want from the startup. So usually when it goes to the startup, it gets overwhelming. And actually a due diligence process is overwhelming. And that's the reason it is very important that you actually keep all these documents ready. Because unless and until you submit all these documents, your due diligence report is not going to be ready. So if it's a financial due diligence, then it will be generally it will be if we cannot maybe go through one by one each thing, but I just overall I'll say it's like, see, minutes of the meetings, any agreements, transactions or agreements with affiliates, if there are any affiliates or related parties, significant contracts signed, confirmation from the lawyers about any legal issues. So financial statements, we had a question about financial statements. So it's like audited financial statements, unaudited financial statements. What it includes is, if if I'm doing a financial due diligence, they will always ask you to give a financial statement up to 30th September also. So 31st March 2023 will be almost more than 6 months back. So they will always need a recent financial status. So unaudited financials of the current financial year is very important. And in many times, startups spend a lot of time here, because usually you have your audited financials done, but unaudited one is not done because they don't do a monthly accounting or bi-monthly accounting. So they might accumulate and do it at the end of quarter. But whenever you are starting your investment process, please make sure that you are doing it more regularly than otherwise. Bank statements, income statements, these are also asked for. Usually, those will be asked for. It depends on what is the purpose of the due diligence. Sometimes, if there is something which requires additional digging into, then bank statements may be looked at very closely. But if the due diligence is for a loan, then probably bank statements will be looked at more closely and compared to say grant due diligence or so. Details of all expenses, items like administrative. So they will generally ask in terms of how the company is spending. Accounting policies followed by the company, that is usually picked up from the auditor report that you will be submitting. In case of business, the customer and customers, list of suppliers, these all is asked, and many times the investors can also do a third party check. The revenue and contribution, it is like if the company is already revenue making, then what is the contribution from each stream of the product is looked at. Balance sheet, of course, is asked for to look at the fixed assets, inventories, the receivables. Receivables also shows like whether you are able to generate cash out of your debtors, or even if you are selling, the debtors are paying or not, is looked at. Loans and advances, other current assets, cash bank balances, creditors. So basically, the whole balance sheet is looked at very closely in terms of only the not the numbers, but how that number is arrived at. It's like if the receivables are high, then with why you are not able to recover money from your debtors. So those could be the questions that you will get based on the financial due diligence. Secured, unsecured loan. If there is any secured loan, then what is the security against which you have taken this loan will be commented on. Taxes, direct taxes, indirect taxes. Direct taxes is basically the income tax. Here also whether you are if you have made payments and whether the TDS is deducted on time or not is what whether the TDS returns are filed on time or not. Indirect taxes will include the in terms of GST, whether the GST filings are done or not. So, and then these are some of the documents with respect to company filings. I mean, whether this memorandum of articles, AOA, memorandum of association, and the certificates that the company gets by various registrations. So all these documents you will have to submit it to the due diligence professional. So just you mentioning that we have it is not going to be sufficient. You will have to submit the proof of it to them. So all the copies of all these certificates should be available in PDF, and you can actually keep it in a specific drive as I mentioned. So I'll just go through this. In terms of grant, all grant agreements will also be asked for. Like for example, we have many BIG grantees. So when we are investing into those companies, then they have to actually submit their grant agreement to these agencies. So if apart from that, if you have any other grant agreement, any other loan agreement, all those agreements you will have to submit. Now, secretarial and HR due diligence, this is what all you will have to submit. So it's all listed here. So I think we can also share this list with you if you want to take. If anyone is interested, maybe they can write to you and we can share it. I think we can take the questions. But, yeah. Yeah. Maybe you can increase it. So
typically, the checklist can be shared. You can write to.
yeah.
I'm putting in an email ID. You can just write to this email ID and we'll share it with you. One of the questions is,
is due diligence restricted to statutory, financial, and legal areas only, or only those which are backed by routine documents? So it's not restricted only to this. So basically, due diligence will include everything that the investor wants to verify before investing into your company. So it need not be only statutory, financial, and legal. It can be with respect to technology also. So it might include, if at all you have licensed your technology, then the licensing agreement will be looked at. If there is a patent, then there will be IP due diligence with respect to that. Is there a due diligence for marketability of product or ability of team to market the product, and how is this due diligence done? Is it largely subjective? So it depends on at what level the investor is investing. For example, in case of venture center, we invest at a very early stage. So the marketability of the product, yes, it is looked at in terms of whether the product is required in the market or not. Probably complete preparedness of the startup for taking the product to the market may not be verified. But once your product is ready or it's close to ready, then if the investor is coming at that stage, then they will definitely want to know how well prepared you are with respect to the marketability of your product. So it depends on the stage at which investor comes in and what is for what purpose you are going to use the investor's money as well. Is there a weightage for different aspects of due diligence? There is no weightage as such, because it depends on what comes out of that due diligence and how significant it is. If there is any deviation or if there is any lacuna found, then how significant it is. So it doesn't depend on pre-assigned weightages as such. It all depends on whether that's going to hamper the startup's growth or not. Does it work on a
Or does it work on a gate basis?
It's from the same question. Yeah.
So what document should we ask from the investor to see if they are legitimate? Yeah, you can definitely ask, because you have to see whether the investors through which entity. See, in case of individuals, usually you can ask only the KYC documents. Individual investors, it's always better to know from the investors in terms of what all are the other companies are in their portfolio. If there is any company which is in the same domain in which you are operating is in their portfolio, then it's a conflict of interest. So you will have to make sure that the investor is not investing in you where they have already invested in a similar company or your competitor. So those kind of things you will have to see. In terms of institutional documents, institutional investors, you can always ask in terms of their incorporation things and all that. So, yeah, are there any detailed information on which on what the red flags for investor and how to handle them? Any video or blog would be helpful. Detailing on what would be the red flags for the investor. So, in terms of red flags is basically if it all depends on whatever compliances are applicable to your company and whether you have met them or not. If you have not met them, then it's a red flag. So at the same time, in our case, if we are investing, if there is something like the startup has not say filed with ROC any document which they are supposed to file. It all depends on what is the consequence of that. So if the things if due diligence report reflects certain things which will always have some consequence, and if that consequence is not detrimental to the startup's functioning, and if it is not going to affect their fundraising in future, then it will be taken in a corrective mode, like you take care of it and we can move ahead. But if it is something which is likely to you cannot take the business forward. In that case, the investors will step back. Those will be the red alerts. It can be something like patent infringement or something which you mentioned that is unique, but it's not actually unique. So all those kind of things will be, or if there is any legal case filed against a founder, or if the founder was a part of a company which has already not paid some debt or something like that. So it depends on what kind of things are found in the due diligence. So it is about if such kind of thing is found, then investors will always stay away from such startups. Basically, how an entrepreneur should be going about doing the due diligence based work. So that's what in case of base work, you can actually check few of this due diligence checklist and keep all these documents ready. So that is the only thing which you can do initially. With respect to your technology due diligence, you can always have everything done with respect to convincing to the investor that your technology works. But when the investor wants to do a technology due diligence along with somebody else, then you will have to follow through the process that the investor sets up for you. You from your end can always have some technical experts contacted who can speak to the investor. You can have some advisors who can always give their opinion, some key opinion leaders or so, who can always talk good about your technology or company, which will give confidence to the investor. You can keep those things ready on your own, but the investor wants to do an independent check, you will have to follow through the process that they tell you to.
Generally, Shruti, as per your experience, how long does the process take, due diligence process?
So, whenever the startups have mentioned that we have everything ready, it still takes 3 to 4 weeks, usually. So, and there have been some cases where it has taken 3 to 4 months also, if the things were not ready. Or, as I mentioned, if there was some loan from the promoters and if they had to issue shares to those promoters, then that process took time. So it all depends on how clean the documents are. So, but there has been a couple of companies where their documents were pretty ready. So that has taken about a month's time. Maximum. That is the least.
Yeah. So minimum.
And that is okay. That is okay. I mean, usually that's the time it takes. Also, it also depends on at what stage the startup is, because in the initial stages when the startup is just 2-3 years old, there are not many compliances that the startup has gone through, or there may not be many investments raised or many things done before. But as if the startup is at say 5 years, 6 years old, and if they would have raised a couple of investments, done a lot of business in between, then depending on the number of years, also the time taken changes.
Yeah.
Because there's those many
But
more.
if they follow the financial hygiene.
Yeah.
Then
Yes. Then it happens faster. That's right.
That is one.
For due diligence, should entrepreneur ask an NDA to be signed? Usually it is not signed. Technical due diligence you can ask, but not for the financial and legal due diligence. There will be a proper due diligence assignment email, or if it is done at an initial stage, it's usually assigned over an email also. But you can, if it is done at a later stage where the company has some lot of confidential information and has done business, there will be a proper due diligence assignment letter, which that the professional agencies usually also sign back, and that is considered. So, but no, NDA is usually signed only for technological due diligences, not for financial and legal.
Okay. Yes, one more from
Are
Hardik.
the DD reports generally checklist based, or are also include insights from deeper study of the documents? It is not only about checklist, it is about the checklist is for providing the documents. They study the documents and prepare the report. So it is based on the insights from the deeper study of the document. So if you, one example which I have seen very frequently is that we have many grantees and they sign a grant agreement, and most of the time the grantor asks them to submit a board resolution. So they just prepare a board resolution and send it. But you will not have a proper board meeting minutes set up which actually mentions that this decision was taken in that board meeting. So if there is no correlation between the resolution which you have submitted to the grantor and same is not reflected into the minutes, then they will always comment on it. So that is from a deeper study of the document.
Such comments
such comments will be there, or there will be some comments with respect to if there is a grant agreement and if there is some obligation with respect to royalty or giving that grant back to the grantor. So those kind of comments will also be mentioned in the due diligence report.
Generally, how long does the due diligence agency take to come up with such a report?
So see, they usually, for us, since our startups are 3-4 years old, they generally say that after all the documents are received, they will take about 10 days or so. but all the documents received is a very flexible
Rare situation.
criteria
Right.
because all the startups don't submit all the documents together. So that's why I have never been able to track whether I received it in 10 days or not, because there will always be some documents pending from the startup side. But that's how they generally promise that within 8 to 10 days, we will prepare a report after we receive all the documents.
There's one more from Sandeep.
If promoter loan exists, say 10 lakhs, how is it handled in usual cases? So it is usually when if there is a promoter loan, the first thing that the investor will ask you to convert it into equity. That is the first preferred way of the investment. If there is any cash into the startup, which is a rare scenario as such, but they may ask you to pay it back before they come into the company. The last and the last thing will be, they will always mention that it will not be paid off until the investors are the shareholders in the company. So they will have that priority for getting an exit from the company before the promoter gets paid. So during investing, is the due diligence done by a firm suggested by the investor, or a startup can get it done through their own firm? No, it is suggested by the investor. So it's usually suggested by them. There could be some initial stage investors who may go with whoever the startup is suggesting, but that's not the normal.
Almost always
It's always the investor who suggests who will be the due diligence.
So let me just alert you before we move on to the next question. The feedback link is in the chat box. Requesting all of you to please give your feedback so that any suggestions we can try to incorporate. Also, the slides for this presentation, we will upload it on our restricted website, and Sharvari will let you know the username and password in the coming few days. Yeah, Shruti, next question is about.
Can you give examples of companies who focus on being due diligence agency? Usually, there will be CA firms or most likely legal firms. They do a due diligence. We can also recommend some separately if at all you want it. But most of the times, if you are going for an investment, then the investor will have a pool of due diligence agencies of their own.
All right. Are there any more questions? We can take one or two more questions.
Do you have separate agency for tech? So at Venture Center, we generally do tech due diligence internally because that is our strength as such. So, but the financial and legal due diligence we outsource.
Yeah.
So we have to.
Okay. Any more questions?
You can again also write at sharvari.naik@venturecenter.co.in.
So this is the email address where you can write with more questions if you have any. And also please do give your feedback. The link is also there in the chat. Our next upcoming session is going to be on 5th of December, which is the immediate Tuesday coming next week. So 5th December at 4 o'clock would be the next session, and we will announce the details in 1 or 2 days' time. Yeah. So I think there are no more questions. So let us close this session for today. Thank you so much, Shruti, for trying to cover a lot of ground, I would say, for a difficult subject like pre-investment due diligence. Any more questions, we can, of course, take offline. Thank you very much.
Thank you.